The live price for Cloudflare Inc. on the NYSE, ticker NET, is $202.30 as of the close on Monday, November 17, 2025, having seen a sharp intraday drop of negative 8.30 points, or negative 3.94% from its previous close, with the market now closed. The critical immediate insight here is that this significant daily movement isn't just a technical pullback from a rich valuation, which was the existing market narrative. Instead, it was directly triggered by a major network outage that occurred today, a single point of failure moment that briefly took down critical online services like ChatGPT and Spotify. This is the unexpected reality that changes the risk calculus for a stock that many view as an essential piece of modern internet infrastructure. The general market expectation for Cloudflare stock, particularly after its blowout third-quarter earnings report that saw the share price surge almost 14% on the day, was that its growth story was on solid footing, underpinned by accelerating revenue, expanding margins, and strong traction in its high-value enterprise and workers' AI platform. Investors were operating under the belief that Cloudflare's technology, while premium-priced, was robust and reliable, making it a defensive growth play within the volatile tech sector. This belief was reinforced by their recent results. Q3 revenue jumped 31% year-over-year, beating estimates, and the company raised its full-year guidance. They've been highly successful in moving up-market, with large customers paying over $100,000 annually, now accounting for 73% of total revenue. This is a very strong operating performance that the market simply did not anticipate maintaining after a period of sales productivity issues earlier in the year. The deeper reality, however, is that today's outage has forced a sudden reevaluation of the company's perceived resilience, something that analysts rarely model with enough severity. The stock was already showing signs of fatigue, having pulled back roughly 20% from its early November high of $260 even before this incident, a move largely attributed to its stretched valuation. It was trading at incredibly high multiples, far above many peers. Today's price action, marked by a gap-down open and a quick flush to an intraday low around $187 before recovering slightly to the $202.30 close, saw a significant volume spike. This suggests an element of short-term capitulation and stop-loss triggers among tactical traders. The loss of approximately $1.8 billion in market capitalization in a single day, directly tied to a reliability issue, introduces a risk factor that the previous fundamental narrative of high growth had largely masked. When you are positioned as the underlying backbone for major high-profile applications, your operational risk is directly translated into your stock price volatility, a lesson that holders of high-growth software stocks priced for perfection, managed via self-investing or a platform like Schwab Intelligent Portfolios or Fidelity's individual brokerage accounts, are forced to learn the hard way. Looking closely at the recent movement, the immediate post-earnings reaction in late October was overwhelmingly positive. The market cheered the 31% revenue growth, the notable expansion in the dollar-based net retention rate to 119%, and the transition to a true enterprise sales organization. This fundamental strength initially drove the stock higher, confirming the bull thesis that Cloudflare is evolving into a core utility for the internet, positioned at the intersection of cloud, security, and artificial intelligence. However, the subsequent 2 weeks saw profit-taking and technical selling pressure set in. The stock started to confirm a correction phase, sliding from its peak towards the $210–220 range, which had served as a psychological support level. Institutional activity around the previous reporting period showed a mix of increased and decreased positions, with large holders like Vanguard Group Inc. increasing their stake, while others like Baillie Gifford & Co. trimmed theirs. This divergence showed that even before the outage, institutional conviction was not monolithic regarding the stock's premium valuation. The technical damage from today is considerable. The stock broke below a critical short-term support level, validating the correction and suggesting a deeper test of price action is likely. The current closing price of $202.30 sits just above the tactical support area of $190–195, meaning the next few trading days will be crucial to see if buyers step in, suggesting the market views the outage as a one-off shock, or if the selling pressure continues towards the deeper consolidation shelf around $180, which would signal a more sustained profit-taking phase by longer-term investors who originally benefited from its incredible 158% run-up over the past year. Cloudflare's core business model is centered on its global cloud platform that delivers a wide array of services including web performance, security, and reliability. It operates the world's most extensive edge network, sitting between the visitor and the hosting provider, offering services like Content Delivery Network, CDN, DDoS mitigation, and website security. The sheer scale and distributed nature of this network are meant to be its competitive advantage, providing unparalleled speed and resilience. This very advantage is what makes today's failure so jarring to the expectation of invulnerability. Their platform, particularly the Workers product, allows developers to run code at the network's edge, which has become a key selling point in the AI space, with management noting that roughly 80% of leading AI companies utilize their infrastructure. This AI-driven narrative is a major pillar of their growth story and why they command such a premium compared to peers. This is further cemented by their recent acquisition of Replicate, a strategic move aimed at becoming a leading end-to-end cloud platform for AI application development by offering instant access to over 50,000 AI models. This acquisition is explicitly designed to fuel the Workers' AI platform and streamline the developer experience, cutting down on the infrastructure complexity that often plagues high-growth sectors. This is the strong fundamental reality that continues to exist beneath the current volatility. However, the competition is fierce, coming not only from direct rivals like Zscaler or Datadog, but also from the hyperscalers, Amazon, Microsoft, and Google in the edge computing space. Cloudflare has to constantly invest in its technology and expand its product offerings to justify its high price-to-sales ratio, which sits drastically above the sector average. The recent Q3 report did show a contraction in gross margins, a point of concern as it reflects the increased capital allocation and mindshare management must devote to resilience and growth, which is now exacerbated by the fallout from the outage. This investment cycle, while necessary, puts pressure on the path to consistent GAAP profitability, which analysts often expect by 2027. Investors managing their self-investing accounts or using services like Fidelity's trading platform or Interactive Brokers accounts should pay close attention to the financial pressure points and not just the top-line growth. Moving forward, the expectation versus reality tension focuses entirely on execution and perception. The expectation is that Cloudflare will quickly and transparently address the root cause of the outage, reinforce their network resilience, and that the long-term tailwinds from AI and cybersecurity will quickly overshadow this short-term blip, driving the stock back toward the analyst target consensus, which recently climbed to the 239 region. The reality is that the company is now under increased customer and regulatory scrutiny. Management will need to prove that they can allocate capital effectively to both robust resilience and continued product growth, a difficult balancing act. Potential catalysts remain extremely strong. The continued adoption of the Workers' AI platform, successful integration of the Replicate acquisition, and expansion of their SASE offerings into large enterprises. Their strong RPO, or remaining performance obligations, which grew 43% last quarter, is a tangible sign of future revenue acceleration that supports the bull case. Conversely, the key risks are clear. Sustained macroeconomic pressures could see large customers delay or downsize spending, and increased competitive discounting from hyperscalers could erode their gross margins further. Most immediately, a failure to reassure the market about network stability could lead to a reliability discount on their valuation multiple, pushing the stock toward the lower analyst-modeled fair value estimates, which are closer to the $140 to $185 range, especially if growth multiples compress due to risk premium. The current price point of $202.30 represents a difficult position. It is well off the recent highs, making it tempting for growth investors, yet it is still priced for near perfection in a moment where the company has shown a noticeable imperfection. The next few weeks of trading volume and institutional flow will determine whether this is a brief, fear-driven dip or the start of a more sustained structural derating. For those utilizing sophisticated trading platforms or engaging in online investing, the chart is telling us to watch the $190–$195 support level with extreme prejudice, as a break lower could initiate a deeper correction. In terms of market engagement, this stock is a favorite among younger investors on platforms like Robinhood Stock Trading because of its high growth potential and strong brand recognition.